start recording. Sorry. Colby had asked me to record this for him. So all I did so far, just for the benefit of the recording, all I did so far is I have a stream of consciousness of here's all the things I did as I researched CrowdStrike. And the very first thing I did was I went to Bloomberg. I did CrowdStrike. I typed DES for the company description, and it brought me here. And then I clicked report to download a report to read about the company. And I'm reading about the company. And so I got to the bottom of the report, critical themes, geopolitical tensions, critical themes, cybersecurity. So this is just a primer on cybersecurity. We know that cybersecurity as an industry is going to be increasing, right? Because the whole world is all very cyber oriented, and there's a lot of political and just hackers and all kinds of stuff like that. So cybersecurity for sure is going to be a thing. I'm not worried about the industry declining in any way. What I am worried about is how is CrowdStrike going to adapt to the changing industry? How are they going to grow? And I'll give you kind of my end result here is I do think CrowdStrike is going to grow. I think they're going to be a bigger company over the next few years, but I don't think they're going to grow fast enough. That's my argument here. So cybersecurity is a much smaller end market than cloud infrastructure and application, and CrowdStrike is specifically looking at cybersecurity in a cloud application, which is kind of weird. So they have well, let me walk you through just what I did, because I'm also telling you things that I've learned since here. But so then I went, after I read those critical themes on that report, I ran BQ for the Bloomberg quote. So BQ is Bloomberg quote, and that's just it's just a quick quote for the stock. So it gives you kind of just here's what's going on. And so I can say, okay, here's some more data, so I can just kind of get an idea. Their 1 year stock return is a 5% loss, right? Their beta on here says 1.195. I separately also pulled up Yahoo Finance because I like to double check things. So hold on. So I just pulled up Yahoo Finance and searched CrowdStrike on Yahoo Finance too. And then so I was like, okay, here's CrowdStrike. And their beta on here was 1.4. I was like, oh, that's weird. They're like way off, like 1.4, 1.19. And so I went to go look at why, and you can actually like hover over this and it tells you their formula. And they use a beta based on the NASDAQ instead of on the S&P 500. And they do a weighting of beta based on the most recent market moves. So you can just read the description of how they determine beta right there. And so their beta is different. So now when I see that, I think, okay, well, I may want to use one or the other later. I'll just kind of get the idea. I do see that they're a $47 billion company, which matters, that their market cap, that matters to me later when I look at their competitors. Okay, I'm just kind of reading through. Right now, I'm just getting data, right? Pulled up Yahoo Finance, double checked, found data. So CrowdStrike has a net loss. And then so I said, well, if they have a net loss, their net income is negative, right? So what's going on to cause that net loss? So I pull up their income statement, right? So I go to Bloomberg Terminal, I type CRWD, FAIS. So I go here, I'm already in CRWD, so I'll just type FAIS, and that's financial analysis income statement. I gotta wait. There it goes. So this is their income statement. So I say, okay, well, here's all the stuff going on, and I'm gonna ignore this grayed one. I'm just gonna do everything to the left of that gray column. That gray column is like the last 12 months. And so this is what's happened in their most recent reporting period. And so I can just kind of scroll through. Oh yeah, thanks. So I can just kind of scroll through here and say, okay, well, where do we start getting negative? So this is their revenues and revenues from different sources. So 1359 comes from their sales revenue. And just as like I found this out later, is like most of their revenue, most of their income is specifically from their subscription products. So CrowdStrike sells subscriptions to their like cybersecurity platform, where they do things like firewalls and whatever other antivirus type stuff, that kind of thing. And so most of their income is going to come from big companies that subscribe to their service. So their other revenue is they get paid to do specific like implementation help, and like companies are like, hey, we got all your stuff running, and we just need you to like come help us do more things with it and be more efficient. So they get hired to do like workshops with people and that kind of thing. So that's some of their revenue too. But the giant piece of their revenue is their sales of their services, right? So then they have some cost of revenue. It brings them down to their gross profit, right? All the orange, like the darker colored lines here, are going to be the main points, and all the yellow ones are like subsets of those, right? So 1359 plus 92 is 1451, and then they have a total cost of 383. Which is broken out into just 383. There's no sub point there. but that's their cost of goods, and that's just the cost of providing. And later I found out that that's Amazon Web Services, AWS, charges them some fees for doing all the stuff through their services, and they also have some cost to Google has a cloud program that they use, and I think something that they do maybe with Microsoft. I'm not 100% sure, but I found out later like where those numbers came from. So 1451 minus 383 gives us 1068. So I'm like, okay, so far they're positive on their gross profit, no big deal. Operating expenses are at 1210. So 1068 minus 1210 is where I'm going to get negative. So I say, okay, so this is where their biggest expense comes in, because operating expenses are bigger than their cost of revenue and it's bigger than their overall gross. So this is where it's going to be big. And so now I can say, okay, inside this orange one is a bunch of these yellow ones. Which one of these is the biggest? And it's selling general administrative expenses. Like, okay, that kind of makes sense because their main revenue comes from selling their products, right? And they're essentially a sales company of security products, right? So I say, okay, so that makes sense that that's the biggest chunk there. And if I open it up, I can see, let me see if I can get a percentage. So I can break down each of those into where they come from, right? And so 839 is the total SG&A. 600 of that is their selling specifically, and then administrative expenses is 200 of that. So I'm like, okay, so selling expenses is going to be the biggest piece of their whole thing. Like, okay, so that's kind of what I wanted to know. So now I got like just some details. They've had negative, that's their operating income. They've had an operating loss forever. And they actually have details going back to 2017 because these numbers were reported at some point, but they actually went public in 2019. So as long as they've been around, they've had an operating loss, which means even prior to paying off their debt, to depreciation, to taxes, or any of that, they've had a loss well before any of those expenses. So they're not really, they're not a very fundamentally profitable company, but I'm okay overlooking that if they have extreme growth opportunities, they're going to be really successful in the future. They can operate at a net loss for a while and be fine with it because if they get to be so big, they can make enough money to overcome that. I'm okay with it. So that's kind of where I am at this point. I say, okay, so I see operating income is where they became negative. And then I started playing. So then I just separately said, okay, I need to know more about this company. So I go CRWD US equity. And then I put EVTS, which is for events, and that's company events. And so I say, okay, well, what are the events for this company? Like, what are the things that are coming up for this company? And so this is a big list of this is actually all companies because for whatever reason it doesn't specify CrowdStrike. And so I said, okay, well, I want to know I'm going to go listen to the earnings call. I'm going to see what's going on here. I'm going to type secure. I have to actually change the date frame too in order to make this work. So I just said, okay, I don't remember when the earnings call was, so I'll just say sometime this year it happened. And then I'll let it load, and then I'll say CRWD. And then when I do that, CrowdStrike had an earnings call. There's only one on here. Let's see if it works. It didn't work. CRWD. And for whatever reason, it's not working now. Why? There they are. For whatever reason, it wasn't narrowing it down, but there's CrowdStrike. Click on the CrowdStrike. And so there's this. Then what pulls up is CrowdStrike's most recent. So I can pull up the transcript. I can pull up the audio. I pulled up the audio. Right. I won't do it right now because you don't need to listen to it while I'm talking. But I pulled up the audio and I just let it start playing. And I just said, okay, I'll just let that play in the background. I'll listen to it while I keep working. So as that's going, I said, okay, well, I'm typing up these notes too. So I get to this point, started playing the recent conference call while I kept working. So I found the conference call through Bloomberg Terminal EVTS, searched specifically for crowd, and then it was on March 9th. If we go back here, somewhere on here, you'll see a date for March 9th. There it is, March 9th. And then, so at the 28:45 mark, so as this was playing, I was doing the rest of these things down here, but then I went back, as I heard things, I went back up and added notes to like this range. And so at the 28:45 mark, they got their future guidance. So they spend like the first half hour just talking about lawyer stuff, where they're like, we're going to make some assumptions, and this is not, we have a safe harbor provision for blah, blah, blah. And so I'm like, okay, I don't really care about that. So I just let it play while I keep researching. But at 28:45, they said, hey, we have a 52% growth in our subscriptions and a 47% revenue growth expected for the future. So I'm like, okay, cool. So I wrote that down real quick so I could look at that when I later do my financial model. This is what they're expecting to happen in the future. So, okay, good deal. And then at the 30-minute mark, only like a couple minutes after that, they started letting analysts ask questions. And so the first, or maybe the first or second question was, they said, "What about preempt?" And then like that was the entire question. They said, "Hey, can you talk about preempt?" And then I didn't know what that meant. I was like, I don't know what that means, so I had to go Google it. And they bought a company called Preempt. So CrowdStrike acquired a competitor. They said that Preempt has a unique product. No one else does that. So as they were talking about it, I said, okay, that's something I need to know in the back of my head as I'm doing this research, right? So I keep going. While all that's playing, I heard them talk about Falcon, and I don't know what Falcon is, so I wrote that down too. And so I Googled it because I'm like, what the fuck is Falcon? And that's their main product. So clearly I don't know anything about the company. So Falcon is the name of the product. So CrowdStrike is the company. Falcon is essentially the only thing that they care about. Falcon is like the number one thing that they do. And you can sign up for Falcon through, like if you're a big, like Chico State could buy, I don't think we do, but we could purchase CrowdStrike subscriptions to like focus on our cybersecurity as a university, right? So the problem is it's get out of here. It's $8.99 for their smallest version is $8.99 per endpoint per month, and I think endpoint means per person. I don't know. So Chico State's for sure as hell not doing that. So they're kind of expensive, right? But maybe that's not expensive compared to the competitors. I'm not really sure. And then you can inquire about pricing if you want the big stuff. So I was like, okay, now I know a little bit about Falcon and what they do. So antivirus, whatever threat intelligence means, USB devices, firewalls. I'm like, okay, I know a little bit more about the company now. So okay, good deal. I know what Falcon is. So now I want some information that I can like. Now that I know about it, I need to start putting together some thoughts. Like I have all these random things floating in my head, and I need to say, okay, let's start putting together a plan for, is this a good company or not? So let's get some metrics. I can get a sense of their risk. I found their beta. I talked about beta for a second, and so the 147 versus 1.19. So I looked at that earlier. Their earnings per share and PE. So earnings per share is negative. PE is nothing because PE ratio is either a positive number or NA, because they have no price to earnings if they're negative earnings, right? So PE is price per share, and right now, CrowdStrike's price per share is 205. So 205 price divided by earnings per share, but their earnings per share is a negative $1.03, and so 205 divided by negative 103 gives you a negative number, and so they report price earnings ratio as just NA, like it doesn't exist. So okay, fine. And then I used EM to find their earnings trends. So I go EM. I'm already in CrowdStrike, so I didn't have to actually retype CrowdStrike. So this is the earnings trends for CrowdStrike. So I'm like, okay, so here's where this information is coming from. I again see these positive numbers, and these are adjusted earnings per share that are positive. I don't really know what's going on here, so I'm just going to say, okay, that's weird that those are positive. The gray ones are all projected. That makes sense to me. Here's their expected growth, and that is a pretty hard decline in growth over the future, right? So that's kind of what I'm looking at here. I'm saying, okay, well, the numbers are going up, but the growth rate is decreasing. And what that tells me is like, yeah, they're going to grow because the industry is growing, but they're going to acquire less of that industry, right? Their competitors might be outperforming. And so that's just the idea here, and that's kind of the things that I'm looking at. I could export this or if I wanted to, but I just left it at this. I just trying to read some stuff. PE ratio, the last 4 quarters doesn't exist, and their expectation for the next 4 quarters is for it to be really high. Price to sales, price to book, and price to cash, the other ones over here. And then EV to EBITDA also is not reported because their EBITDA is their earnings before interest, taxes, depreciation, and amortization, which is their operating income, like after their operating income. So they have a net loss at that point, and we know they're losing money after SG&A expenses. So SG&A happens, then they report EBITDA after that. And so if they're losing money after SG&A, that means they don't have an EBITDA. And so they have a net loss. So the value per their net loss is not reported either. But they expect that to go up in the future, and they have a multiple expectation in this kind of cash flow model that we'll look at later. Anyway, so I want to pull some information. So I did all that. I used EM for earnings trends. I got a lot of data. Then I went to CN for company news. I'm like, okay, let's get more stuff here. So CN is company news. And then I pulled up an article from, you can see, so the articles that I read are marked in gray now. So this Seeking Alpha article is the first one because I read through them. So like I read through the first 3 for sure. And then I just started scanning my eyes through to see, okay, well, what's relevant. So price target and buy rating, that might have been relevant, but I didn't read it. Ads, end phase, energy, exit, Illumina, that doesn't matter to me at all, right? I don't care about this article that has nothing to do with CrowdStrike, so I didn't read it. This delayed, so some news articles get delayed because they use insider information, and so excuse me. So the journalist is told, hey, listen, we'll tell you some insider information, and you can report on it once we announce it, so that you can be the very first article that comes out after we announce it. And so they say, okay, deal. And in exchange, the journalist has to not share that information, right? And so they say, this was delayed, meaning I wrote this article, and they said, don't post it until we tell you you're allowed to post it. That's what delayed is for. And so I looked at Seeking Alpha. I pulled up the Seeking Alpha article. And actually, it made me log in. So I had to pull up Seeking Alpha on a separate browser, I think. Yeah, like this. But it didn't matter. You can go like create your own. Actually, maybe I can sign in with Google. So now I'm signed in here, and this is their reasoning for why they think they're going to have $5 billion in annual recurring revenue by 2025. That's this plan here, and I don't see it, but that's what their argument is. And they have on here an article that CrowdStrike published saying like, here's what we plan to do. And if you see my document next to you, there's a thing on here where I copied from that article, right? So this is a screenshot from that article. But I scrolled down, it's like, okay, so they have a thing on here, a graph. TAM stands for total addressable market. And what that means, TAM, total addressable market, means how much is there available for them to go after. And so CrowdStrike's argument as a business is like, hey, the current market size is this much and we have this market share. But if the whole market grows to be gigantic and we have that market share, we're also going to be gigantic. And that's their argument. My argument after reading about this is, yeah, that may be true, but I think your competitors are going to grow faster. So our large and expanding total addressable market, and they say by 2022, this was published prior to 2022, but they said in 2022, total addressable market is 54 billion, and they think there's an annual compound, so the CAGR stands for compound annual growth rate. So they think there's going to be 11% annual return for the next 2 years to get us to a $67 billion market size for the entire market, everything available to CrowdStrike at 67, and CrowdStrike needs to acquire as much business out of that as it can. And so I'm going to use this in my model later. So at least I got that information. So I said, okay, cool. So I got that. I got company news, 5 billion by 20. Oh shoot. So 5 billion by 2025 or 2024. And then 50% increase in cyber attacks. That was part of their argument. They said cyber attacks are coming up a lot. Education and research institutions were the most targeted. And then top competitors named market cap. So I wrote this out too. And I needed some information about their competitors. So I said, okay, well, what are the different companies that are competitors for CrowdStrike? I didn't write down where I got that from, but let's do that. So inside here, I might want to go EV for enterprise value, and then see if I can pull up their competitors through this. On there, I forget where I pulled this from, but I'll find it in a minute. So I pulled up a list of some of their competitors, and I just broke them down so that and then their market cap, so the size of the company. So I highlighted CrowdStrike. This is Palo Alto Networks, Fortinet or Fortinet or something. And I highlighted those because they're like the biggest ones that are most relevant. Microsoft, of course, is gigantic too, but I don't think they're as relevant as Palo Alto and Fortinet. I think those ones are probably the big three here for cybersecurity. Microsoft does too many other things. They're not a perfect comparison. And the other companies are probably also cybersecurity, but they're so small. And I mean, $6 billion company, but it's small compared to the $50 billion companies that these three are, right? So I said, okay, I'm gonna really focus on those three. So that's from that article. And then I said, okay, now let's start doing some data analysis. So I go to Bloomberg, I go XLTP, which is the Excel template library, and I pulled in a few different graphs, and I actually starred them. So the way I'm going to do this, I'm going to say list view. And you can see the ones that I starred are these are my favorites, right? So you can star for yourself on your own profile. You can star anything you want. And I chose in-depth analysis, the financial analysis, in-depth fundamentals, comparable valuation, and company snapshot. Actually, comparable valuation, I think, is where I got the list of potential competitors. So I'll open comparable valuation to start with. I didn't spend much time on this file, so we'll just do a real quick look at competitors, and then we'll move on. Man, taking a while here. And for whatever reason, Bloomberg is not turned on this computer. Hold on a minute. So I've noticed that if Bloomberg is like checked but not showing, if you uncheck it, save it as unchecked, and then go back and recheck it, it sometimes fixes it. I don't know why. Not now. So here's what I'm going to do. Wait for it to finish loading. And then go, if I hit the flag key and do Excel, I don't know, I have to do add-ins. There's a install office add-in. I want to hit install. I probably have to close. So Bloomberg is now fixed. Okay, good. I probably have to close Excel and reopen it, but I'm going to try this real quick. Add-ins. On add-ins, go. Turn Bloomberg on and off. Or off and on, I mean. There you go. So now Bloomberg's available for some reason. I don't know why. I'm going to enable content. And then now we have this data here, and I want to get a different company. So I can change here. I can say CRWD US. Actually, hit enter. See if anything updates. Nothing's updating, so I probably have to close this and reopen it. So I close Excel. It's kind of a pain. I don't know. I did this on my computer in my office, so I already had Excel add-in turned on. So I think that's just the issue. But I need to be able to use this to show you tools here. So. It's not on there anymore. Sorry. While I'm doing this, does anybody have any questions about anything I've done so far? No, actually, because I end up getting another thing later where I'm like, oh, I don't care about that anymore. Why? Do you want me to talk about it? I think it was just market drop for like COVID fail in the end of 2021. Not that I saw. I'm gonna try closing this. Close Excel entirely. Then try it. I'm gonna pull up Excel on its own. I want you all to be able to see the DCF model because I've messed around with it a lot to be able to have like a good plan. Okay, so now that's accessible. So now I'll skip the comparable valuation. You can see that in there. And then the other things that So I did XIDA. If I go back real quick to my list, XIDA is in-depth analysis. Let's do that. So in-depth analysis. Open that one, and that's just like detailed look at CrowdStrike. Then DCF model, and that's where I did most of my work. And then there was also one for one of the other ones. I forget what the other one was. There you go. In-depth analysis. And then I switched this to CRWD US. Now it's working. And then, so this is kind of helpful to get a good understanding of what's going on. So in-depth analysis lets you look at things like, here's their peers, right? Here's a list of all their main peers, right? So this is VMware, this is Fortinet, Datadog, and I don't like Datadog at all. I'll show you why, because I started looking at their competitors and I thought things looked a little weird, and it's because Datadog is weird. And so I say, okay, cool. So here's kind of the overall view, right? 52-week high and low, their beta. Their year-to-date stock return, not great, 1%, 52-week return down, 6-month return super duper down, right? And then I look at their business segments, nearly all of it is subscriptions. And then their geographic, most of it is the United States. I'm like, okay, that's fine. Like now I know their business model is almost entirely exposed to one thing, which means it's really easy to understand. But the downside is they're not diversified at all. I'm like, okay, fine. So I can go look at some of their stuff, like what do they have in terms of assets and everything. And then I can go look at their indices. So this would be, if you go on indices, this is a combination of all the different peers. And you have to actually click the calculate index button to go look at what the actual, this is a NASDAQ that they use for their index. So the blue line is a peer index, which is like just them and their peers like created in a portfolio. The dark blue line is CrowdStrike specifically, and the orange line is NASDAQ. And so, okay, fine. So I can kind of see what's going on. I can kind of see their stock price, and this is price and volume. So I can see there's a huge spike in volume at the same time as this this drop, right? And so that actually was, I think, just the COVID fail. And then some of their financial stuff, but I'm actually going to use the DCF model to go over some of these financials. But I do want to look at, that's kind of weird. I don't know why this is all zeros. These are companies that have ratings on these. So they say, well, what do they think it's going to be? So the KGI thinks it'll be a $308 stock. FBN thinks they should be worth $311. For whatever reason, in 2024, they think it should be worth $442. I think that's ridiculous. But they have their own, estimates for some of these. So I say, okay, fine. So now let's go XDCF, right? And so XDCF is the discounted cash flow model. Discounted cash flow. That's the one that I want to use. I'm going to open it. And so how do I work with discounted cash flow to try to figure out what I think this company's stock price should be? Let's go over the data that it provides first, because what they do when you first open it is it gives you like, here's our best estimates based on all these things. And their estimates are trash. They're not good. So I'm going to show you why I think that. So CRWD US, it defaults to IBM. So I'll just change that. Let it change. Let it go through its process. It'll start adding colors. It'll start adding little things. And then when it's done, we'll go through and see why, what's going on. So here's the outline. And when you very first look at it, if you're not comfortable with like if you just haven't used it a lot, it's hard to just say like, okay, where do I start looking, right? Because there's just so much, and it's really dense. So I will say start with this information. So when you put in their ticker, you always in Bloomberg have to put US. Make sure the name updated so you know that the data is working. And if that's true, you're good to go. And then there's 3 buttons: summary, input, and output. And so let's go click on summary first. I can't click on anything. Oh, summary is the top. So we're already on summary. Then I go to input. I say, okay, what are the inputs? And this whole table here is all inputs, right? All the way down here, all the way down until we get to here where we're at output right here. This is where output starts. So I want to mess with the inputs in order to figure out what the output should be, right? So up here, this is just kind of like just a summary, and that's fine. And that's if I wanted to just type in the stock, CrowdStrike, hit go, let it run, gives me a summary of everything it thinks. And you can see right here, it thinks there's a 219% upside for the total value of the firm, or possibly an 11% upside to the stock price. I'm going to go ahead and highlight some of these. I'm going to say, I'm going to add conditional formatting. I think for me, making this color code on here makes it much more visually appealing. Like I can like, in my mind, I can identify quickly with this kind of color scale, but I'm used to this kind of color scale, so you might not be. So I can say, okay, cool. So here's what we're looking at. Maybe they'll have if we expected a 7% perpetuity growth and a 9% cost of capital, they would be really high in stock price, 91% return. That'd be great, but I don't know if that's right or not. Right? We're gonna go figure out. This really bothers me because I see when I first look at this is their terminal EBITDA multiple. What that means is multiple years out, we can't keep predicting what their cash flows are going to be because who the hell knows what's going to happen in 2028, right? And so at some point we say, okay, screw it. We're not going to try to predict cash flows. We're just going to say that they're going to have like a constant growth at some point. Let's just say, you know what, from then on, starting in 2027 or something or whatever, actually, if I scroll down, it's starting in 2028. So starting in 2028, we say from then on, they're just going to grow at some constant rate because who the hell knows? And I forget what rate they assumed in here, but I changed it later. And so they assumed some rate of constant growth from then on. And they said, based on this exit multiple, and this exit multiple is what is the current valuation multiple of the peers right now, and let's pretend that that holds. And then that, so the valuation in terms of the PV is enterprise value, and EBITDA is earnings before taxes, earnings before interest, taxes, depreciation, and amortization. So they say enterprise value is the whole value of the company, and that's just like their market cap and their debt combined, basically. And EBITDA is how much money they make. And so this multiple thing is supposed to look, it's kind of like a PE ratio, right? PE ratio is price to earnings, but price to earnings is their stock price and their net income. And that's fine, but like there's too many variables involved in that. So if you're just using PE ratio, there's too many ways to like game the system, right? So you don't necessarily want to use PE ratio if you have other choices. And so we use EV to EBITDA to say, well, EV is the total value of the firm in terms of their market value of equity and the debts on the books. And that's fine for the total value of the firm. But EBITDA is pretty much not manipulated by companies nearly as much because EBITDA is their sales, their cost of goods sold, and their selling expenses. And for this company, selling expenses is the main expense. So that makes sense, right? I want to include selling expenses, but I don't want to include like the other things like interest and taxes, depreciation, and stuff that can be manipulated. So EV to EBITDA is a good multiple, but these numbers are huge, 100 times, right? So I'm looking at it like 100 times is a little much, right? So I say, let's go to data, or actually additional data. Let's go to additional data and figure out why the hell that is. So that number comes from here, the median of their EV to EBITDA multiple. And I look at this and I say, okay, their median is 106. And I look at this list and I say, wait, what? Like, these are all zeros, which means they're not included in this function at all. And then stupid Datadog is 2,000, while the other ones are 17, 74, 138, right? So I'm like, okay, Datadog is clearly like the outlier here, not very good. And Datadog is a smaller company, so I'm like, they're not really a peer. And so I look through here and I see, okay, well, VMware, that makes sense. Fortinet or whatever, that makes sense. But then, like, and then Palo Alto Networks is on here, but they have nothing. Palo Alto Networks doesn't have anything here. So I need to start modifying this list. And what you can do in these yellow cells, I can put in here. So I can overwrite Datadog with, I'll put Microsoft as an example one, even though I don't think that's a good one to use. But if I put Microsoft in here as an example one, all of a sudden Datadog gets overwritten, there's no 2,000, and my median becomes 50, right? Completely, like instead of 100, I'm at 50. I go over here and I say, okay, so now we're at, instead of this 200% potential return, we're at 60% potential return. And that's before doing, that's all that is taking Datadog as an outlier and removing it, right? I could just not have this at all, and instead I could just put like nothing. I'm at 74, right? So I just put nothing in there. I'm at 74. That still gives me 120% an upside. So I'm like, okay, 11% stock price gain. Okay, maybe. Let's start looking at some other things, right? So let me go back to here. So that's like DCF model, and I go to U211. Okay, so I'm gonna go through with, this is what I actually did. So anytime I pull up these Bloomberg models, it comes in with, they like highly edit their pages to make it like supposed to look like a nice report, but it's really difficult to like work with. So I go to view, I go turn on headings, I turn on grid lines, and now I can like see a little bit, and I can like actually go to places. So I'm gonna go up here into this top left corner. I'm with that U211 because that's where I went to start with. And so U211 is actually down here. And so this is their expected value once they start, they say, so in year 5, this number is supposed to represent, hey, we're not going to try to figure out what their actual income is going to be every single year. We're going to give it a constant growth rate from now on. And that's the value of the firm at year 5 with a constant growth rate just made up at that point, right? And then these are the individual EBITDA for the firm. Sorry, I said value of the firm. I meant EBITDA. The EBITDA for the firm for each of those individual years, we can take with all of that information, we can then use free cash flow analysis. We can try to figure out what the value of the firm should be based on these time frames, right? This is free cash flow up here. They do the exact same thing in this model as well. We say, okay, so those are the cash flows of the business. Now we can go down here and say, okay, with those cash flows, so estimated value per share, their current price, right? So they say this estimated value per share comes from the equity value and the shares outstanding, right? So they just divide. See, they divide those numbers. This equity value is from the current enterprise value, and the current enterprise value comes from present value of those cash flows. So you kind of work your way through it, right? So present value of those cash flows, their WACC at 10.5, their terminal value. Let me do this here. Their terminal value exit 74 times. Where's that? That comes from P49, which is way up here. This number. So this P49 number is what they're expecting the exit to be, 74.5, which is 74.5, right? So now I can say, okay, let's modify this number a little bit to figure out how that exit answer comes about. So that's kind of what I'm doing, right? And I'm going through this all. I'm just trying to get a good understanding of the DCF model. Well, here's what I can do, because I think their revenue estimate right here has year-over-year growth assumptions, 48%, 35%, 29, 30, 25, 22. That's their growth in revenue every year. I don't think that seems pretty high, especially because if I go back to their report, they think there's an 11% growth in the market, right? So if they think the market's growing 11%, they have to acquire all of the new growth and more. And I don't know that that's going to happen because they have competitors to deal with. So I'm going to say, let's not do like 40% growth rate. And I can click this edit row button, and it creates this new drop down. And the way that this works, this is weird. I had to fool around with this for a while to figure out how this works. If you don't click on this, because these are actually buttons. All of these are buttons and not just cells. And so you can see 48, 35, 29, 30, 25, 22. Those are blue because those are checked. If I click here, that changes it, right? Now that's a new button. So by clicking 42, it unchecks 48, right? And so I can decide which of these do I want to use, the best consensus, the 5-year moving trend, or the best consensus for earnings per share long-term growth rate. Well, okay, fine, I can pick those if I wanted to. But instead I said, you know what, I'm not going to do that. I'm instead going to say, what do they currently make? They currently make $14.52 on a total market of 54.8. So I pulled up a calculator and said, okay, come on. I pulled up a calculator and I said they make 1.42 on a market value of 54.8. So they have about 2.5%, 2.6% of the market. Well, 2.6% of the market in 2024, when it's worth 67.1 times 67.1, means that they'll have a total revenue in that year of 2024 of 17.38, right, or 1.738 billion. So I say, okay, well, what if that's the case? I go, their actual value in 2024, 1.738 billion, right? And actually, I can't put 1 point because this is in millions, so I need to put 1,738. So I put that number in there, and then I'm going to split the difference because this is going to look super weird if they have a 42% growth rate and then a decline, right? That doesn't make any sense. So I need to change this number to be halfway between them. So halfway between 14 and 17 is about 15.5. So I'll say 1550. I'm just going to let it load. I'm going to say freaking out. There's weird numbers going on. And then now I can say from then on, let's say we have a compound annual growth rate of 11% every year, because that's what CrowdStrike thinks it's going to be. It starts breaking when I start putting in weird numbers. This is what I think is more accurate. Okay. So now I have some numbers in there, and you can see this is what I think their growth rate is going to look like. So I can close that menu now, and now I go back up here and I say, oh yeah, there's a pretty significant loss. So maybe it's 183 instead of 209 or whatever. And so that's one piece of it, and that was a major factor here. Now there's another part too where I say, I think their main like factors here is their spending on marketing and sales and stuff. And so what I did then is I said, okay, well, let me go figure out let me go figure out what's going on with the company, and let's go look at what the actual reporting is saying. So they have 10-year annual reports for 2022 and 2021 and 2020. That's the 10Q. Oh, I opened the wrong file. Sorry. This is CrowdStrike's annual report for 2020. So ending 2022, but it's covering 2021 year. And so I went through and I looked at some of these things. I looked at their properties. I looked at their risk factors, right? Here's all the different risks associated with the company. And I just read through this real quick. But the main thing that actually made me like stop was management discussion and analysis. So, yeah. So item 7 is management discussion and analysis. So I scroll down to there and I say, okay, what's the discussion analysis piece? So they're monitoring COVID. Okay, fine. Like they have security cloud. They say, hey, we have some risks associated with being online. People are going to try to, like, we're a cybersecurity company, so everyone's trying to hack us. Because if they get into us, they can get into basically anyone in the world. So they say that's some of their risks, that kind of thing. And then factors that affect their performance. Adoption of solutions. So customers actually adopting their thing. Okay, that makes sense. New customer acquisition. That's basically the same thing. Fine. Maintaining customer retention. All of that is like perfectly fine. Key metrics. Subscriptions is their key metrics. And then I look here and I say 2020, 2021, 2022. Key metrics of subscriptions. In 116% growth in subscriptions, 82% growth, 65% growth. It's increasing, sure, but it's coming down. And so I say, you know what, they're kind of on a downtrend, right? Their numbers are going up, but they're going up slower and slower. And I kind of think of it like a parabola, where, yeah, on the far left of the parabola, if the parabola is like pointing down, right, or it's an upside down cup shape, right? Moving from left to right, yeah, they're coming up really fast. But then as you get closer and closer to the peak of that parabola, you're moving up slower and slower until eventually you start coming down, right? And so that's kind of what the trend that they're on for the last 3 years. And I said, well, 3 years isn't enough. So then I also went back and I found their 10K for the previous year. It's the same thing. This was like 120 before this or something. And so I just kept looking back at a few past years to see what that trend looks like. Their annual recurring revenue is how much money they make from their subscriptions. So I said, okay, well, maybe they have less subscribers, because I don't necessarily care if they have less overall number of subscribers if those companies are gigantic and paying them a lot of money. So I say, okay, well, what's their actual revenue? Well, same thing. It's declining. It's increasing revenue. Revenue's increasing. And so at the top level, that looks good, but it's decreasing at a slower rate. So eventually they're going to turn around, right? And then they have a thing that they call dollar-based net retention. Same thing, right? Flat. In this case, it's flat. So it's like, okay, so that's kind of what's happening is they're making more money per customer, but they're losing customers. So they're making more money, but less fast. So they're kind of flat overall. They say, okay, fine. And then down here, they say, here's some of the things that, what do they put the title? Components of the result of operations. So on my notes, let me go back to my notes here. On my notes, I say somewhere down here, sorry, I gotta find it. I'll go to Edgar here. So as I'm reading through it, I found a line where they said that they don't pay dividends. They don't ever plan to pay dividends. So I was like, oh shit, I gotta go look and see if that's a factor. It doesn't affect it at all. So okay, fine. EV has nothing to do with dividends, so I just ignored that. I pulled up the key drivers affecting our performance. That's what I was talking about. You can see that they're coming down. And then dollar-based net retention. And then there was another piece on here. Apparently I didn't write it down. Maybe I didn't hit save on my computer. But down here they say operating expenses. So operating expenses are sales and marketing, right? And then sales and marketing expenses primarily consist of like salaries for our sales team, that kind of thing. And then in here there's like a throwaway line, but it made me, like, kind of convinced me. We expect sales and marketing expenses to increase in dollar amount as we continue to make significant investments in our sales and marketing. Like, good, that makes sense, because this is supposed to be a growing company. further penetrate the market and expand our global customer base. However, we anticipate sales and marketing expenses decrease as a percentage of our revenue over time. So what they're saying is they're going to keep building the company, but not contribute an adequate amount into their sales and marketing expenses. So yeah, we'll increase our sales marketing. We'll be a bigger company, but we're not going to keep pace with our overall growth. And if their driver of their growth is decreasing, even though they're growing, they're going to grow at a slower and slower rate and eventually start coming down. So when all this started happening, I said, okay, fine. I don't even, that like kind of sealed it for me. R&D, they had the exact same line somewhere in here. Although research and development expenses may fluctuate, we anticipate research and development expenses to decrease as a percent of revenue. So R&D, because they're a tech company, is going to be going down, right? It's going to be growing at a slowing rate. And sales, and they're a sales company, so both of those things are going to be declining. And so I said, okay, I don't really want to be in them then. But if that's the case, then maybe I want to go change some of these numbers, right? Gross profit might change because, well, actually not gross, it'd be operating expenses. Operating expenses might change at a slower rate, right? They're going to continue to slow this down over time. And you can see this is coming down, but I think it might come down faster. And so you might want to change some of these. So I get to that point and I say, okay, you know what? I don't think I want to be in this company. And I'm already at a point where once I got rid of Datadog as that outlier, we're already looking at a negative return. There's a lot of factors in here, but that's how you might modify this, right? And look at it. So we're coming up at the end at 1 o'clock, and I just talked a lot and fast. So I'm gonna stop. I should have stopped like 30 minutes ago, and said, you know, what things can I like point out, can I help with, so that you all can use this effectively. Do you have the Bloomberg tab available at the top? Next to help. Yeah, on Excel. Okay, so Bloomberg's not installed. So hit the flag key and type add ADD, and then it'll say install Office add-in, and then you got to turn on the Office add-in thing. You got to do what I did, where I had to close it and open it like 4 times, and eventually it started working. Yeah. Go for it. Yeah. So WACC is weighted average cost of capital, and it's the cost of their equity financing stock and their cost of their debt financing. And I don't necessarily care too much about what WACC is, because in this table, they actually assume that WACC could be some number within a range. And so I'm okay with that being a pretty wide range. There's a line where I could change the step on here. Instead of going from 0.5% each time, I could change it to something else. But that WACC is, what does it cost to fund the company, right? So if they're going to fund the company by issuing stock, or they're going to fund the company by issuing debt. And then there actually is, I think on here, the WACC. So they use the discount rate. Oh no, this is their growth focus. Maybe they don't have WACC listed on this. You can go find, we could do this. We go to Bloomberg Terminal, and I just go WACC. I'm already within CrowdStrike, so it'll pull up CrowdStrike's WACC. So they have 98% funded by equity, 1.8% funded by debt, and they don't have any preferred shares at all. And the cost of financing, so their cost of equity is 10.7%. Oh, sorry, what? Their cost of equity financing specifically is, what does it cost them to use stock to fund the business? So they have 2 choices to fund the company. One is through debt, which is issuing bonds, and that's pretty obvious. That's just purely what they pay to borrow money, right? That's their loan interest rate. Equity is not nearly as obvious. It's what does it cost them? Like if they were to, it's like where you have a choice of like, you can do multiple things, and you say, I'm going to pick this one, so I'm foregoing the other ones. Yeah, like an opportunity cost. Yeah. So they're saying, well, I'm going to finance through equity. So like, what am I giving up here? And it's gonna cost me 10% of the value of my like how much of my fundraising by issuing stock, because I have to pay for that stock in one way or another, right? There's some risk premium. The way they calculate it is with capital asset pricing models. So they say risk-free rate, equity premium, the beta of their stock. Now, I looked earlier at the beta, right? And I said, oh, well, someone else said it was 1.4. So if I change that, that gives me a 12% cost of equity. And I say, okay, I'll update my model with that. If a 12% cost of equity puts their WACC at just shy of 12%, and I go back to this table and I say, well, I might want to up this a little bit, right? But either way, I'm going to be, if their WACC was to increase, that actually puts me more negative. So they were in a better scenario before I tried to fix their, their numbers. So I'm going to hit reset, overwrite my data, and then close it. Oh, I have to hit reset and update it. Sorry, and hit update. And then so I can say, okay, economic value added, return on invested capital. And I can kind of see how things are moving over time. So that's how WACC. Sam, does that answer your question? Yeah. So that's how WACC works. WACC is their cost of financing, and if they're going to have a cost to finance the company, that means they have to grow, and it costs them something to grow. And so, depending on what it costs them to grow, this is what it might look like over time. Yeah. What other questions can I answer or help with? This model is somewhat complex, right? But I think you all are, you've been doing this for a little while. We've had a couple of sessions talking about the idea behind this. I really would love for you all to play around with it, see how it works. And then the other thing I would say in Bloomberg is XLTP for the Excel template library. XLTP. Go to list view, and then just like look through all of it. There's so many things on here, right? These are all different Excel files that you can download. I mean, look, I'm at 250. I'm still scrolling. 310. 310 different Excel files that you can download and play around with. Now, I could say I am an analyst. I don't really care what region I'm in, but I only care about equity, right? So now now there's 133 that are specifically about equity, right, for analysts. But maybe I'm a portfolio manager. So we have teams in the SMIF. There are teams. One of the team is portfolio, right? So we have an equity team, we have a portfolio team, we have a macro team. So I might want, as the portfolio team, might want to look at some of these, right? I might want to say, well, I'm on the macro team, so I can find whatever macros is in here somewhere. Economist, that's fine. So I'm an economist or strategist, and maybe I just want all. So AOI is area of interest, right? So all areas of interest within economics, and I can go find look at the price yield spread, right? There's a lot of things on here that you can use. So that's it. That's the idea. What other things can I help with? So my pitch to the SMIF is let's not take a position on CrowdStrike. I don't know that we need to vote on that. Who told me to do CrowdStrike? I forget who it was. Okay, was there a reason behind it? Oh, no, oh, gotcha. Got it, okay. I was thinking, man, I couldn't remember who it was. And it's like, man, whoever pitched it might be like super into it, and I'm gonna like hurt their feelings or something. Yeah. Sure. Yeah, absolutely. So that's my overall thought process. I'm super scatterbrained, right? Like as I'm just going through it, I'm literally just writing down like, here's my thought, and I just go say, okay, well, what's this? What's this? What's this? So you all upload that Word file to our Discord. So that you can go download it yourself and just like walk through my process. You can copy everything I did, but do it for different companies. So, I have been trying to download the Zoom after it's done recording and post it on the Discord. So you can go there, and then I also post them on YouTube. There's a Center for Excellence in Finance YouTube channel, so they're all not all. And I'll just keep uploading to that. I'll try to keep remembering to put it on the Discord. But you can always just ask me. I have every time I record on Zoom, I have a Chico State profile for Zoom, and my profile has every recording I've ever done. If you want to see every class I've ever taught, you can go on there. Yeah. What other questions? What else? Okay. You're the new guy. You don't. I mean, just like you're just checking it out. But there like anything I can help to kind of get you more understanding what we're doing? Yeah, it takes a while. There's a huge learning curve. Oh, yeah. Yeah. So this is like I would call this step one, because then what you do is let's say I came to a different conclusion. Let's say I think CrowdStrike is awesome. We should buy it. Then the next step is saying, well, if we're gonna buy it, what's the price we buy it at? So I have a sheet on there. I printed out a couple where it was just like my overall ideas, right? I put like my entry expectations. I put like a profile description of them. I put like their current PE ratio, their current beta, their current market cap, all that stuff. And then I put on there, like, if we are going to buy them, I have like a minimum baseline for my personal trading. I want a 10-to-1 risk reward. And so I said, well, if they're currently at like 208, or I forget what they were when I did it, but they're somewhere around like the upper 220 something. And so I said, well, let's say we get in at 210 at the worst. If I get in at 210 at the worst, and I think they're worth, like, I eventually did a bunch of numbers where I said, I think we can get them at like I forget what it was. Maybe it was like 250 or something. Actually, you have it right in front of you. What did I put for my target price? 229. Okay, 229. So I said, well, if we're gonna, yeah, that's target exit. Yep. So I say I'm gonna buy it at 209, and if we get out at 229, that's like a 9% gain, and that's not really that great. But I want a 10-to-1 risk reward. That means I'm gonna put my stop loss at a 1/10 of that 9% gain, so 0.9% loss, which only lets me have a range of like 206 or something. Is that what it was? 206? At my exit downside target exit, or no, my stop loss exit. Sorry, 208. So that says worst case, I put a stop loss at 208. Well, today's stock price is 205. Yeah. So it's already, it would have been stopped out. So had I done that, we would have been out of it immediately, right? So I just don't think it's like, in order to have a 10-to-1 risk reward, you have to have a target of like 10 times more than their average daily move anyway. So we really need to focus on stocks that are going to have like a 50% upside in case they're super volatile, right? And so I didn't put this on here, but I've just downloaded their historic stock price from Yahoo, like every monthly stock price, and I did their average monthly volatility, the standard deviation of monthly moves, and it was pretty wide, right? They're very volatile, and they have a beta. If their beta is actually 1.4, or even if it's 1.19, like it's 1.2 or something, that was my range of beta. That means it's very volatile. It means their daily moves are moving a lot anyway. And so I don't want to be in a stock that's super volatile unless I'm saying that I'm targeting a much higher return in exchange for my more risk, right? So that's the idea. So if I'm expecting a 40% gain, then I'm willing to have a little more risk on it. You just raise your hand. Oh, okay. Those are all my different thoughts, and I'm clearly like not very organized with them. I just start thinking of things as I'm going, and I just okay, let's look at this. Let's look at that. I would like to. Well, as I was doing it, I was like also thinking about the structure of the fund, like how we're going to do this. And I kind of think like I don't expect you all to be at the same speed as me. I talk fast, I type fast, I move fast, and I've been doing this for a while, so I'm comfortable moving fast. But I don't expect you to be that fast, and I don't expect you to be as confident as I am, because like I can just sit down and start doing stuff, and you all are students. Don't worry about it. But I'm kind of thinking like for next semester when we're doing this, we might want to spend like a long time on one company, right? For each of us, like maybe picks a company or goes in teams and picks a company and spends a long time on that one company to really come up with a good analysis. Maybe we get a week into it and realize this is garbage, we'll move on. And that's fine. We can abandon a company quickly, but if we're going to stick with it, we want to spend a little more time on it. And then maybe do all of our trades towards the end of the semester or something. And that's not as exciting from a student perspective. Like I think as a student, you want to be like day trading. You want to be in and out all the time. And I get that, but Chico State's not going to be on board with that, right? I see a chat on here. Sorry. Oh yeah. Yeah, no worries, Jessica. Yeah. So that's kind of the way I'm like approaching it for the fall. Is to be honest with me, because I want to make sure I'm as supportive of you all as possible. Everything I did just now, do you feel like, oh yeah, I could do that, or do you feel like that's way too complicated, I gotta learn more, or somewhere in between? I'll be gone. I get it. Oh, but I mean, but you all are almost like the leadership of this. Like it's like we need to get started somewhere, and so there's gonna be a bunch of new people too. Yeah. Okay. I think maybe instead of having all those like specific companies, yeah.
You don't like CrowdStrike because you figured out they want
Right. What I would have done here, if this was like when I was actually expecting to like make a pitch to, like I don't pitch to the SMIF, right? That's not my role. But if I was expecting one, I might have said, you know what? Now that I don't like CrowdStrike, Fortient and Palo Alto are their two competitors. Let's repeat this with those two and see if CrowdStrike's not going to be good. That might mean that Palo Alto is going to take a big chunk of their market share because there's a lot of consolidation in that industry. But I knew nothing about this industry prior to 8 p.m. last night. I did all of it. I came in last night and did all this, right? So, I mean, this is just like the fastest thing, right? But okay, sorry, I cut you off. Yeah. Okay. Okay. Matt, are you gonna be here in the fall?
Yeah.
Okay. Brad, are you too? Okay. So within you're graduating for sure, you're graduating for sure, you're graduating for sure. I'm not gonna ask you to like make a commitment yet because this is day one for you, so don't stress. But oh, gotcha, you're brand new finance major. Yeah, awesome. Congrats, welcome. What were you before? Wow, big move. All right. Cool, good deal. So you're now a business major, and you weren't before. Are you a first year?
No.
Yeah. Just becoming business? Have you taken business classes before?
I have.
Oh, okay.
I was thinking about it for.
Yeah, because business is like you have to take all the core and everything.
Yeah, I've already done.
What are you in 307 right now?
Yeah.
Okay, so you still got a ways though, but you can knock out 307 this semester, 351, 355, and some of the 400s in the fall, and then like 460 and something else in the spring, and then maybe be okay. Yeah. Yeah. Okay. Yeah, welcome aboard. But yeah, no, you don't have to commit to anything yet. But okay, so we'll have some people, and I'm going to send out announcements to students. One, over the summer, I'm going to send out announcements to all the incoming business majors so that we get like fresh, quote unquote, into the group, because we need students who are going to be here as first years to see what's going on so that they can be leadership roles in their juniors and seniors, right? So yeah, but then yeah, so you all who are you graduating? Yeah. Oh, okay. So then you all, you two. What's that?
I'll be here.
Oh, that's right. Oh, I think you were graduating. Oh, you're doing study abroad.
Yeah,
that's what it is.
Then I gotta bring it up.
Yeah. Okay. You're graduating. What do you care? Yeah. Okay. So the university has a fund for students who are like exceptional to do things. And I don't. That's not the right way to describe that. But it's called instructional related activities, IRA. And so we used it before with the Investors Club to go to Chicago. They paid for us to go to Chicago with that because we won a stock trading or a commodity trading competition. And so I was talking to our associate dean, and she said, we can use IRA funds. See you, Ruben. Have a good weekend. She said we can use IRA funds for travel, and because there was, I won't name the program, there's another program that has discontinued in the College of Business, and they used to travel a lot, and they were like shut down. And so now they have all these travel funds and no one to use them. And so they just said like, hey, what could we do for travel? And our dean loves the SMIF idea. He came from the University of Dayton, which is in Ohio, and they are the largest student managed investment fund in the country. And so he's trying to like brand himself as the dean who starts student managed funds. And so he wants us to be gigantic too. And so he's trying to figure out ways to help us. And so there's a conference, it's called the Quinnipiac. They're a major like polling company, but they're also a university, Quinnipiac or whatever. And so they hold a conference for student managed investment funds in New York City every year, every spring. And so this year's already done, but next year they'll do it again. And so the university said, we can send you to that conference. And I said, well, we just did like a guest speaker from New York Stock Exchange. He said, hey, if anybody's ever in New York, come hit me up. So how about we make a big thing out of it? And they said, okay, cool, we'll do that. So I haven't actually asked Colby yet. So if any of you talk to him, don't ask him until I do, please. But we'll see if he can get us a tour of the New York Stock Exchange. We'll do that. We'll be in New York. We'll do the conference, the Student Managed Fund Conference. They bring in big investment managers to talk about what they're looking at, how they run their thing. You can hear from other universities that have student managed funds. We'll get a good sense of how they structure their stuff. We can maybe copy them or beat them.
We automatically like sign up. Do we need to do anything with that email that?
The email that I sent you for New York, I didn't send an email about it. I posted in Discord, hey, if you guys want to go to New York. Yeah, but that was just like this. So I treat Discord like text. Like I just like, hey guys, let's do this. It's awesome. If I send an email, it's formal. Yeah, and so I did not make a formal announcement to all the finance majors because they're not all allowed, right? We have like $20,000 or something in travel funds. We can't bring every finance major. And if I'm the chaperone as the faculty member, I don't want to bring like 40 people. I don't want to keep track of that.
Like, do we need to do anything now?
No.
That's not
Oh, yeah. I have to apply for the funds in October, and then the university will grant them. It would be really weird for them to say no now. And then when the funds are available, I put together an itinerary and I buy plane tickets and I do all that stuff. I'll take care of it for you. I'll at the time when it comes around, I'll make sure we get a solid commitment from who's going. And then if you sign up to go and I buy you a plane ticket and then you back out, I would be really messed up about that. But I don't know. Yeah, so that's the idea. What else? Can't think of anything else. Any other questions? Oh, yeah, sorry. Yeah, I can get you added to it if you want. Yeah, it's just we have a group Discord for everybody in Smith. And there's a bunch of people who aren't here right now who like Jessica's on Zoom right now, and then actually Landon joined on Zoom. I don't know if he's still on there or not, it doesn't look like it. But he was on there too. And then there's other people who come in normally at random days. We can't make it all the time. Yeah, I'll get you on the Discord in a bit. That's it. Any other questions? Awesome. We're after 1, so we'll call that good. Yeah, no worries. Jessica, are you good? I don't know if you can hear me or not, but are you good?
Yeah, I'm good.
Cool. I'm gonna go ahead and hit, end the Zoom then. I'll hit stop recording and stuff, and then I'll post this on Discord later.
All right.